Subscribe to our YouTube channel and press the bell icon to get the latest updates.
When popular stocks find no takers, their stock prices move sharply southwards. Then they are labeled as falling knives. Investors believe that buying such stocks is akin to ruining their portfolio. I often find the falling knife questions on stocks in my mailbag. The latest ones are on the stock of Nykaa, listed as FSN e-commerce venture. The stock has fallen like 9 pence in recent months. Even a generous bonus issue did not stop the slide. In fact, the selling pressure has accelerated in the days following the bonus issue. Hi, I'm Tanushree Banerjee, and today I'm going to tell you whether you should continue to bet on tech disruptors like Nykaa, Paytm, and Zomato regaining their lost glory in the stock markets next year. Now, Nykaa was nothing less than a market favorite just a year back. The stock listed in 2021 at sky-high valuations. No one batted an eyelid even when the valuation multiple crossed 3 digits and stayed there. On the contrary, investors clamored to the uniqueness of the business model and its projected growth. Nykaa was amongst the first to retail beauty products online in India. At a time when physical distribution of such products was a huge challenge, Nykaa made beauty shopping a fingertip activity. But now, Nykaa's core proposition of being a multi-brand platform is at risk. The company currently makes a big chunk of its revenue from brand advertisement. But Nykaa is no longer the only platform for such beauty brands. Several deep-pocketed competitors in the beauty and skincare segment are cannibalizing on Nykaa's share. The Tata Group is the latest to plan what it calls a beauty tech venture. So Nykaa's share of ad revenue is at grave risk. Apart from losing ads, Nykaa's existence as a multi-brand platform is itself at risk over the longer term. Intense competition requires players to forego profits and offer massive discounts to starve off competition and retain customers. Therefore, meaningful increase in Nykaa's profitability is ruled out for now. Foray into fashion and other verticals can only temporarily solve the margin problem. Plus, they need heavy cash investments. Nykaa plans to add 25 to 30 retail stores per annum. So its future performance will be dependent on its ability to leverage on its brand image without compromising profits. Capex on new stores and spend on acquiring brands will continue to be a drain on cash flows. Understandably, investors have realized the mistake in valuing Nykaa for perpetually high growth. The stock has halved in the past 12 months. Nykaa is of course not the only stock bearing the brunt of investor agony. Zomato is down nearly 50%, Paytm is down almost 60%, InfoEdge has corrected 40% from its 52-week highs. But did the stocks deserve the lofty valuations in the first place? A quick glance at the fundamentals of these supposedly high-growth disruptive companies tells you that the businesses are still far from being minority shareholder friendly. While the sales growth may seem attractive in most cases, the companies have been extremely lax on profitability thanks to the high rate of cash burn in the initial years. The problem is that in most of the cases, there does not seem to be even a feasible plan to cut down on the cash burn rate. Now, typically, managements that own the business for the long term look for sustainable growth rather than quick near-term upside, which can destroy value. Did you know the founder stakes in the stocks like Zomato, Paytm, Policy Bazaar, Car Trade Tech, and Delivery is less than 10%? None of these are under promoter category. Hence, there is no compulsion to disclose the buying and selling of shares in the open market. The stock of most of these companies took a sharp hit as pre-IPO investors and institutional investors rushed to exit post the expiry of the lock-in period. They did not find value in these stocks even at beaten down levels. The lesson here is to check if the company you're considering investing in has enough promoters' skin in the game. Globally, behemoths like Amazon, Netflix, and Meta have this year shed a whopping 40 to 70% of their market value. So the question is whether all such promising high growth businesses, especially tech businesses, become falling knives in a market downturn. More importantly, what should investors do to identify and avoid such potential value destroyers? Of course, new age tech stocks cannot always be valued based on earnings. Balance sheet assets are out of question since most of the assets are digital or intellectual property. So, high risk investors and hedge fund managers follow what they call the rule of 40 to evaluate the growth return prospects of such businesses. The 40% rule is that the company's growth rate and profit should add up to 40%. So, if you're growing at 20%, you should be generating profit of 20%. If you're growing at 40%, even generating 0% profit is acceptable. If you're growing at 50%, even losing 10% should be pardonable. If you're doing better than 40% rule, that's awesome. When applied sensibly, the rule of 40 offers early stage investors a quick check on the health of the new tech companies versus their growth. Yet, one must understand that such businesses could have extreme volatility from time to time. They have several drawbacks versus steady high cash businesses. Limited revenue visibility, sharp volatility in margins and cash flows, growth dependent on capex, discounts or ad spends, these all eat into their margins. Therefore, a sharp correction in valuations should not come as a surprise. Now, whether Nykaa will continue to be a falling knife will depend on the management's ability to offer earnings visibility in the coming year. The sharp correction in valuations was both necessary and meaningful. Though Nykaa remains a relatively high-risk bet, investors keeping a close watch on its financials and valuations could take a contrarian bet. As Seth Klarman says, be contrarian with a calculator. You need both. The calculator is to prevent junk. Hope you like this video. Do share your comments on the experiences that you have had while investing in new age tech stocks. Thanks for watching.